Right, hello everyone, and welcome again to my channel. So today, as the year comes to a close, I will be for the first time revealing my portfolio performance to everyone watching here today. I believe that by doing so, I can journal my own mistakes and areas that I can further improve my performance. I will firstly say that my AUM or my portfolio assets under management is nowhere near most of the local YouTubers personalities that provide financial service. Therefore, I do not find the need to disclose my AUM to you guys here. But again, I'm not in their game to achieve FIRE. In the case you do not know what FIRE is, there is actually a new movement in YouTube with the investing community here that teaches audiences how to achieve financial independence and retire early, or alternatively it's called FIRE. Unlike the FIRE movement, my game is to focus on stock picking and practicing it over time to eventually try to beat the market. Instead, I believe that my AUM growth should be a byproduct of my hard work and passion in understanding the value investing game better. As an important asset to have in value investing should be to train my psychological mindset and be counterintuitive when it comes to investments. Okay, so before we dive into my portfolio performance, please help me like my video and subscribe to my channel. Your support is greatly appreciated. So to begin, I will first show you where my funds has been allocated so far. I have two separate funds with two different objectives. Fund A runs with the objective of being passive, and I only reinvest all dividends into the S&P 500 Index ETF and the S&P 80 Dividend ETF. While my second fund, Fund B, is an active fund that aims to beat the performance of my first fund, Fund A. Therefore, my game is to prove to myself that with hard work, focus, and a good mindset, I can eventually beat the market. So the question now here is that, did I really beat the market this round? So let's move on deeper to see. Okay, so we first focus on my first fund, Fund A, which is the passive fund. So far in this fund, I've been purchasing the S&P 500 ETF and the SPYD ETF. So what are they? The SPY 500 ETF is an ETF that replicates the S&P 500 index, or the top 500 most valuable companies listed in the US, while the SPYD ETF replicates the 80 highest dividend paying companies listed in the US. The SPYD currently pays a dividend of 4.7%, but because I am not a US citizen, my dividends are taxed. Therefore, the yield should be lower than 4.7%. So in this slide, you can see here that my 1-year performance on Fund A, inclusive of dividends reinvested, is currently 16%. Let's now turn to Fund B, which is my active portfolio fund, on the next slide. Here are the stocks that I have been invested in so far. So what are my holdings? As you can see here, my holdings are mostly in Mapletree Industries, which is listed in Singapore, Asanda's Real Estate Investment Trust, listed also in Singapore, OCBC Bank, which is also listed in Singapore, and then going from there, I have LVMH, which is Louis Vuitton Moet Hennessy, listed in France, Stone Co., which is listed in US, Kraft Heinz, also listed in the US, Apple, also listed in the US, Google, and American Express, both also listed in the US. So you can see the weights of my holdings here in terms of percentages. You will notice that my investment focus is not just in US companies. I believe that by diversifying away from the US is the only way I can try to beat the S&P 500 index. You will see that my top 3 holdings is currently in Apple, American Express, and Asanda's REIT, a Singapore real estate investment trust. All of my stocks in the US and the Europe is held a little over 1 year, while my stocks listed in Singapore is held for almost 13 years. So These are the weights of my investment in terms of the countries I've invested in. Most of my concentration is still in the US, and I actually wish to diversify more outside of the US over time. But even though I have a wish to diversify outside of the US, I will say that looking at investments from a macro perspective should not be my priority. My priority will be always to focus on value of the business first. Whenever I see an opportunity, as long as it is a good buy, even if it's in the US, I will still take the bite. So I will go wherever the opportunity takes me to. I must always remember to be fluid and adapt to the situation as it presents itself. From my experience, many times when opportunities present itself, you will definitely find it very scary to make the move. Why? Because being contrarian requires stepping out of the unknown, and you need a huge leap of faith. Doing research is important, of course, because only when you know your business well, you can rely on your circle of competence and back up your conviction with the data you have uncovered. But even with the data presented, it is natural that fear will still grip onto you when you see that everyone starts selling and move into safer, higher paying assets. Self-doubt will start to creep in, and you will be tempted to sell at a loss like everyone else and move into the safer paying assets. But as Benjamin Graham of The Intelligent Investor puts it, fear when others are greedy and greed when others are fearful. By the way, if you have not read the book The Intelligent Investor, I highly recommend it to be your first investing Bible. But from my experience, once you are inside the situation where everyone starts selling, very likely you will be tempted and you will forget all the theories that you read in books. As human instinct will naturally kick in, telling yourself that you will need the money because you are not sure how long the crisis will prolong, and perhaps your road to retirement may be affected once all your savings are wiped out. So, the moral of the story here is, it is indeed not easy to be a value investor. No matter what lessons you have learned before, you will be indeed put to the highest test, because this involves human instinct to fall back into being safe rather than sorry. Very easily, you'll be succumbed to it. Another error in investing is hoping for the truth to be true even though this isn't the case. This is called false biasness. It is very dangerous to fall into the trap of false biasness. This is why, to me, you must never wear many hats in the world of investing. There is no right, no wrong in this game. Therefore, I will not put down any school of thought. Be it if you are a momentum trader and you do well in it, or a fire-focused investor and you also do well in it, or a value investor and you also do well in it. If you feel that your strategy works well, then really focus on it. The worst advice you can give yourself is to focus on all of the above, meaning you watch several YouTubers or read blogs online and then tell yourself you want to be a master in trading, build a good passive income portfolio, and also be a master in value investing. Doing so will only result in self-doubt when a bad situation in the market arises. Therefore, I strongly advise you to always have your own investing style. Everyone is unique, has different investment objectives, and value things differently. Therefore, investing to me is indeed 70% an art and 30% science. So here you can find my breakdown of my portfolio allocations from my active fund. You can see that so far I still have a quite large weighted portion in bonds of 41%, equities 46%, and cash 11%. These bonds comprise of Singapore dollar denominated government and corporate bonds. I will not be breaking down my investments in my bond portfolio today because my eventual aim is to deploy most of it into equities over time, but subject to the opportunities presented to me at that time. So far, I would say that most US stocks have already been pushed up quite a bit due to the recent Fed's announcement of a possible rate cuts by next year, as the current inflation numbers seem to come down in the US recently. That is why, if you have watched my company health check series episodes, you will notice that I have recently recommended to stay put and not add on into any positions for the US companies I invested in. If you have not watched my previous videos, do tune in to my company health checks episodes and watch my take on these stocks. I believe that most funds will be starting to move back into the US equities market as a flight to quality until the Fed's announcement of an actual rate cut happens. So, I believe we must not follow the herd and look for opportunities elsewhere if any. However, I will still be holding on to my equity positions as I see a lot of future growth potential in these companies I purchased so far. I will let the power of compounding do its work and watch the assets of the companies continue to grow. In this slide, I will present to you my individual cumulative compounded stock returns purely from capital gains over the years. As I mentioned earlier, most of my US and Europe stocks have been held a little over 1 year only, while my Singapore stocks, I have already held them for almost 13 years. Therefore, as you will be able to see, I think my performance in the US market is pretty impressive because I purchased most of my investments when the market feared last year, as investors started dumping as soon as the US kept rising interest rates to keep inflation down. In this slide, you will see that my Fund B equities portfolio has provided me with a weighted average 1-year return of 26%, while my Fund A index portfolio provided me with a weighted average 1-year return of 16%. You will find that the S&P index recorded a 1-year return of 22.5% to date. I also compared my portfolio with the MSCI, or the World Equities Index Fund, performance at 16% returns to date. On all fronts, my equities portfolio have beat both the S&P 500 and MSCI World Indices with a comfortable margin. However, if you look at my overall portfolio, which includes my bonds and cash weightings, then my total portfolio return for the year have averaged only to 14%. So, how will I be investing in 2024, you might ask? To be honest, I'm never a pessimist when it comes to the US economy. If you were to say that there's a large-scale recession that were to happen in 2024, then I highly doubt it. Will there be a correction? I would say yes. A correction is highly possible and should already be due. Many market watchers, I believe, have overpriced the Fed's recent news, especially so when the Fed's signaled an initially highly unlikely rate cut. So I will be waiting for this correction to happen. Sometimes markets tend to overcorrect from the profit taking and will present buying opportunities along the way. I think that now until the early first quarter 2024, most market watchers have indicated optimism for US stocks, and we should continue to see short spurts of rallies until closer to the Fed's decision for the next rate cut, which many believe will be somewhere in March 2024. I'm still unsure how many rate cuts will there be next year, 3, 4, or 5? By how many percentage points in total will be the rate cuts be? I really don't know, and I won't attempt to guess. No matter what the case will be, this will be the time I start preparing and building my war chest. I've learned from my own experience that when a reversal happens, most of us are always caught unprepared, as we have already used up all our ammunition by being too bullish. Therefore, I now spread out my cash wisely and not throw all eggs into one basket all at once. So, at the end, have I beat the market? I would say not yet. Why? Because I'm not in the market long enough to make any real judgments yet. In the short term, it is easy to beat the market, but try 10 years. It will just get tougher, and most participants will just average the market returns over time. If you think it's not true and Warren Buffett has beat the market in many years, he has participated in it since the 1950s, think again. I do not deny he has been one of my inspirations to get into the game of value investing, but it's no longer easy to replicate his performance as a value investor in this era, where information, especially in the US, is so perfect that any substantial returns will already be quickly competed away. Great assets will be snapped up before you can even put your money on it. Therefore, to replicate a superior long-term return, you really need to have a great foresight to spot good assets selling at attractive prices quickly, which is of course very hard to come by. In conclusion, I want to wrap up by saying that we should all eventually build our own investing style. It is very important to learn the basics and fundamentals and then build your own style upon it, which means educating yourself by reading more, learning what you don't know, and education, I believe, is still very important no matter what your experience level in the market is. There is still many things we do not know about ourselves and the vast marketplace. Being too overconfident will definitely bite you in the ass when you least expect it to happen. So, slowly master your game. Always know why you are in the game for and focus on the reason why you are in it. Mistakes will surely be made, but no one is perfect. Be always humble to learn where you went wrong. That is why FIRE is not for me at this point of time, as my goal is to grow my AUM from long-term compounding market returns. Till then, good luck in your learning and investing journey, and for the win, guys. Stay tuned for my next episodes. Alright, see you.